Hi, I'm Jeff Tucker, Principal Economist at Windermere Real Estate, and these are the numbers to know right now. The Fed has finally started cutting. The two big questions are why and now what? So I'll start with the why. The labor market has started showing signs of distress. The August jobs report delivered more bad news, continuing a streak of weak job growth since April. If we look at the level of jobs, the overall growth of non-farm payrolls clearly passed a turning point this spring, as growth has slowed to a crawl from over 170,000 jobs added per month prior to this April to just 27,000 a month on average since April. Moreover, the quarterly census of employment and wages just revised away more than half of the job growth previously estimated to have happened in the year ending March 2025. Wiping out over 900,000 jobs originally thought to have been added in those 12 months. Historically, as this chart by Jeremy Horpedal highlights, big negative benchmark revisions, like the preliminary one released this month, have occurred during recessions. And big negative monthly revisions to the jobs report, like last month's, have also been more common just before recessions. Now, this doesn't mean a recession is around the corner, but it helps explain why the Fed is changing their posture to try to stop a recession before it gets going. One challenge they're facing, though, is that they have paused their fight against inflation before it was quite finished. Annual inflation stopped falling this spring and has now reaccelerated to nearly 3%. The more volatile monthly inflation rate is running at 4.7% annualized. Part of the reason the Fed is now willing to cut may be that they view some of this inflation as a transitory one-time bump from tariffs, which they're willing to look through. But I think the biggest reason is just that the warning sirens in the labor market became too loud to ignore. Turning to the housing market, the balance of power has swung in buyers' favor this year, thanks to higher inventory. But it's now clear that inventory passed an inflection point. For the third month in a row, the pace of growth of inventory has come down again. Now it's down to just 21% growth from August of last year. So at the end of this August, there were just under 1.1 million active listings on the market, actually down slightly from July, while each of the last 3 years saw inventory continue to grow into August. This means buyers are still favored in many markets, but they can't count on that pendulum to keep swinging further in their favor. Especially because of the huge news for everyone in the housing market, mortgage rates have fallen to the neighborhood of 6 and 8%, roughly their lowest level since 2022. Investors were anticipating this rate cut by the Fed. And if anything, the fact that the Fed was willing to press ahead with cutting rates in spite of the recent firmer inflation data demonstrates their commitment to focus on helping the labor market with easier monetary policy while setting aside the inflation fighting for another day. Maybe more than anything, that change of posture by the Fed is helping to bring mortgage rates low enough that well-qualified borrowers are starting to see a 5 handle without paying any points. And there's no guarantee that these low rates will last, though. Just look at what happened last October. So I advise everyone to strike while the iron's hot. If rates do fall further this winter, well, you could always refi then. That is all for this week. Thank you as always for watching.